Okay, the solution to the second of the additional problems from Module 7. All of the same background information as before. This is a 60% owned subsidiary. Little reports income of $100,000 each year, and in this case we have an upstream sale of a patent. The patent was sold from little to big for $42,000. The patent had a book value of $30,000 and had 3 years left to run, and we're going to assume that big uses the full equity method. And again, what we need are the equity, the entries, and the income of the non-controlling interest for 2018, 2019, and 2020. So, first order of business. In 2018, what do we have to do? We have to eliminate the gain on sale. Let me go ahead and change the formatting on this. There we go. We have to eliminate the gain on sale of the patent, and we have to restore the patent to its correct book value. Again, correct book value was 30. It had been written up to 42,000 when Big bought it. Second order of business is, do we need to recognize some of the gain or loss? Now in this case, the transaction took place on January 1st. That means that Big, the new owner, is computing and recording amortization expense based on the inflated value of $42,000. They're going to record $42,000 over 3 years, or $14,000 per year of amortization expense. The correct amortization expense is $30,000 over 3 years, or $10,000 per year. So we need to go ahead and fix the amortization expense. We're going to go ahead and undo $4,000 of amortization expense. So we debit the patent and credit amortization expense. Okay, finally for the income of the non-controlling interest, they're going to get their share of Little's adjusted / realized income. So we start with reported earnings of $100,000, subtract out the gain that we took away as being unrealized, and then give back $4,000, saying that of that $12,000 we took away, we're going to give $4,000 back. So $100,000 minus $12,000 plus $4,000 is $92,000. 40% of that is $36,800. Moving on to 2019, we go through the same drill. Now, the patent account is the easy one. In 2018, we credited the patent for 12, we debited it for 4, so we're carrying forward an $8,000 credit to the patent account. That's the remaining unrecognized gain or loss, unrealized gain or loss. And now we have our two questions. First, was this an upstream or a downstream sale? This was an upstream sale, which means the non-controlling interest is going to be involved. The non-controlling interest is going to get their share, 40% of that $8,000. So 40% of $8,000 is $4,800. The other 60% of that, 40% of $8,000 is $3,200. The other 60% of that, the $4,800, is going to be the parent's share. And now the second question is the parent using the full or the partial equity method? The parent is using the full equity method, so we're going to go ahead and debit investment in Little. Okay, so we've carried forward the remaining unrecognized gain, and now we need to go ahead and recognize part of that by adjusting the amortization downwards again. So again, we're going to go ahead, just as we did in 2018, we're going to go ahead and undo a portion of Big's inflated amortization expense. The income to the non-controlling shareholders, they're going to get their share of the reported earnings. And again, we look at these elimination entries and say, how did these elimination entries affect earnings? Well, we put a $4,000 credit on the income statement. That makes income go up. And since this was an upstream transaction, that is shared with the non-controlling interest. So that the income of the non-controlling interest is going to be 40% of $104,000, or $41,600. Finally, in 2020, we'll do the same thing one more time. We carry forward the remaining unrecognized gain or loss. Okay, so again, last year we had $8,000 that we carried forward. We recognized $4,000 of it. So we're carrying forward a $4,000 unrecognized gain. We have to go ahead and split that between the non-controlling interest and the parent, since this was an upstream transaction. So the non-controlling interest is going to get their share, 40% of that 4,000. The parent, via their investment in Little, since this was an upstream transaction, since the parent uses the full equity method, we're going to go to the investment in Little account for their share, 60% of that 4,000. And we, for the last time, reduce the patent by $4,000. If you think about it, this is the last year of the patent's life. On January 1st, 2020, Big had on their balance sheet a patent with a book value of $14,000. They had bought it for $42,000, and they had amortized it at $14,000 per year for 2 years. So Big's patent was $14,000. The true or correct patent value is only $10,000. It was on, back at the beginning of 2018, it was on the books at $30,000 and would have been depreciated at $10,000 or amortized at $10,000 per year for 2 years. So it would be down to $10,000. So what we're doing here is, again, we're correcting the patent value, taking it from the inflated book value of $14,000 down to the correct book value of $10,000. Now we need to go ahead and, again, adjust the amortization expense. So we're going to go ahead and debit the patent and credit amortization expense. For the income to the non-controlling interest, it'll be the same as it was back in 2019. They're going to get their share of Little's adjusted/realized earnings. Reported earnings are $100,000, plus we've got that $4,000 increase in income due to the removal of part of the amortization expense.